What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is July 2nd of 2018. Well, folks, today I want to spend a decent amount of time to talk about something that's been on my mind as of recent and has to do with traditional markets. For those of you out there who keep active with the DataDash channel and watch the daily updates, you know that I provide a good mix of coverage between crypto and traditional markets. And whereas I generally hold a very bullish view long-term on the potential of cryptocurrencies, I tend to hold a very contrarian or bearish viewpoint on equities markets. And the reason for this is because that I analyze things in a fundamental perspective first and foremost. And when you spend a good few hours looking into equities markets, you'll realize just how flawed traditional markets in general really are, and that we're repeating over the past 10 years since 2008 a lot of the same flaws that led us towards the recession in 2008. So I've been holding this fundamental viewpoint on traditional markets for a very long time, but if you were to look at my trading record, you'd see that I'd actually be trading in a very bullish perspective. When I was very active in equities markets from 2013 to 2017, I was trading to the upside. I was betting that stocks were going to keep on rising, and this was due to the fact that even though the fundamentals were flawed, that the rules set in place were not going to allow equities markets to decline, and that was both quantitative easing, artificially low interest rates, practically 0% interest rates, meaning that money was pretty much free to borrow for the time being. So because of these factors, there was a lot of things that were going to keep markets alive, and I didn't trade against that. I knew that it was going to keep things alive. But when those rules start to roll back and the quantitative easing turns into quantitative tightening, what changes come into markets? Well, I want to talk about two key indicators today that have taken me from being not only a contrarian on the fundamental sense, but also on the technical perspective. And these two key indicators are important things to watch if you're looking to see the current status of the market, because they've historically been good indicators of showing when markets are going to turn. So let's go ahead and dive into these two key indicators. Today I'm going to be taking a look at two major ETFs, XLF and XHB. These two ETFs measure two different things. XLF is a financial sector ETF created by SPDR, and there's also another SPDR ETF for home builders. That's the XHB ETF down on the bottom chart. So why are these two ETFs very important? Before we dive into the TA side of things, I want to spend some time to talk about the obvious factors here. The XLF ETF measures a lot of the large commercial and investment banks. So think Bank of America, Wells Fargo, and then you get your investment banks like Goldman Sachs and JP Morgan and Chase. I mean, you've got a large pool of financial banks here in one smack middle ETF here, so you can get a good gauge of how the entire sector is moving at the moment. And along with that as well, we've also got the Home Builders ETF, and this is important because the Home Builders ETF obviously is going to show weakness points if the housing market is looking to have a downturn, or it's going to show signs of strength if people are getting more confident, if consumers are buying more homes and the housing market is looking to be more positive over the next quarter or so. So because of that, these are very key indicators to look at. But we can see that over 2018 so far, they've actually been on a correction and have been making new relative lows as of recent. So why is this important? Well, I don't really want to focus so much on the downside. You can always look at downside on charts and say, oh, this is the next recession, or this is the next recession. I'm not here to really state that. What I'm here to focus on is take a look at not the short-term factor of price action. This is the weekly chart, so each of these represent a week. But I want to go back and take a look since 2008. Now, the reason I want to do this is because we've seen a striking similarity between these two major indexes. These, again, are very key things to watch because this is the price. This isn't some technical indicator. This is the price that people are paying for investment in generally an entire sector here. And look at this. You don't need to be a TA expert. Tell me if you notice something here. And I'm going to let you guys, I'm going to give you a few seconds to think about it. Just go ahead and take a look at the chart. It might be screaming obvious, or it might be screamingly obvious to you in this sense. I don't know if that's a word, screamingly, but it might be extremely obvious to you that for the past, for these two indicators here, that we have reached the same exact highs for both XLF and XHB. So both in the financial sector and the home building sector, we have reached the same exact highs we had in 2008. And along with that as well, we've seen a stark sell-off from those tops. I mean, we saw a massive decline here from around $48 a share down to below $40 for the home builders. And if we focus in on the financial sector, I'll expand this a little bit, we've seen that we've gone from $30 down to $26 and are breaking towards new lows for the year. But the reason that this is important is because it's showing that we are taking those 2008 levels into account. And it's not to say that we can't test those levels again and that we can't make new highs, but the fact of the matter is that we are starting to get towards the end point of this market, folks. I can't tell you all if everything's gonna flash sale tomorrow. I think every contrarian would love to see that and be proven right. And I can't tell you if it's gonna be another year or two, like many bulls would say. But it is becoming very obvious and clear that here, in the sense of price action, we are getting towards the end of this credit cycle. We are getting towards the end of this market run-up. It has been a great run-up. It's been more than 10 years since the lows of 2008, and people have made a fortune on paper. Some have actually cashed out, some have done great. But again, your gains in these markets are not solidified until you cash out. It is all on paper until that moment. And I'm not telling you guys to just drop everything. If you have a 401k, I'm not telling you to exit out of it. Do as you please, do your own research, but I'm telling you all that you should be prepared. And if anything, what I'm doing, I'm going to be diversified in a sense. I'm going to be exposed in cryptocurrencies. I'm going to be exposed in precious metals sooner. I'm going to be looking to get gold and silver and just diversify and distribute myself outside of just traditional equities markets, because we have had a fantastic run up. This is not the time to really get bullish here. So these two key indicators are showing warning signs. It could be a warning sign that the housing market is potentially looking to have a correction, whether it's as bad as 2008 or not. I don't know if I can claim that, but we definitely are looking for a correction in the housing market. And the banks who have made a ton of money, especially the investment banks, again, borrowing money cheap, taking all this corporate debt and injecting it into equities, where they can pretty much borrow money for close to 0% and make 6 to 7% on a general index fund, with equities continuing to go up, it was an easy bet for the time being. But why is it that the housing market might be set for a correction, that maybe people aren't borrowing borrowing money to buy houses as frequently? Or why is it that equities might be going down and that might lead towards a correction in the financial sector specifically? Well, it's been due to those rules that we talked about earlier. And we're going to go ahead and shrink our charts here, but still make it clear, where you can see since 2015, the later part of 2015, really since 2016 through 2018, we've started to see the rise of interest rates again. The economy has supposedly been growing. We've been having more strength in the economy. That's, in my opinion, laughable, and that's not a hit at any specific, I would say, I know people get very controversial about politics and stuff like that. It has nothing to do with certain presidencies or anything. It has to do with this thing right here, the Fed funds rate, the rate in which it costs to borrow money. We've had this, again, practically towards 0% for the past 8 years from 2009. In 2016, when we started to turn that record, when we started to raise interest rates, look at how that started to affect these two sectors. I mean, you look, for example, initially at the first real rise from practically 0.1% to 0.4%. Not even a full percent. This is 0.3%, 1/3 generally of a percentage point of interest rate hikes. And look at what that had as an effect on both the home builder and housing market. A general 25% correction from their previous highs at that time being. 25% off an interest rate hike. It doesn't seem very healthy to me. But anyways, we continue to raise rates over time, and now we're close and steadfast towards 2%. And we can start to see, as we start to go up that level, we start to really test towards this mid-zone area back towards the decline in 2008 for interest rates. Markets are starting to feel a little bit of the pain. We're starting to obviously see that both the financial sector and the housing market might be due for at least a short-term correction. I don't know if this will be the end all of the financial sector, as many people would say, but I will say that things are overextended in this market, folks. Okay, and the quantitative tightening rather than quantitative easing is going to be hurting the market. You have the Federal Reserve exiting a lot of the holdings off its balance sheet. It's getting rid of a lot of those mortgage-backed securities that it bought. It's getting rid of U.S. Treasuries. And in this case, we're at a point where equities are quite priced. They're highly priced. Sorry, I'm kind of messing up on how to put that into words, but generally speaking, you get my point. Equities are on the higher end of things, and we know that we buy low, we sell high. We don't buy high, and we don't want to sell low. At least we don't want to. Maybe some of us do, but that being realized, I want you guys to be on the right side of things. So I'd like to hear what you all think down below. What do you guys think about the financial sector showing these early signs of a decline, as well as the home builder ETF that we're taking a look at here? Do you think these are good indicators? If you have a different viewpoint, guys, feel free to share it in the comments down below. I want to get a discussion going. I'm not trying to fearmonger here in any sense, but I want to share this with you all because, again, time and time again, history tends to repeat itself. And all you have to do is look at the indicators, look at the price action, and when there's enough signs that start to show you that the fundamentals are going to be coming back into play, it might be time to start considering them in your trading and investing as well. That being said, everyone, thank you all so much for watching. Hope you all have a wonderful rest of the day, and I'll see you all soon. Take care.